Hello, everybody. This is Jim Kenney for the weekly market update for OptionProfessor.com. And of course, this is Friday, the 12th of April, and in 2019. As always, I do encourage everybody to understand that past performance is not necessarily indicative of future results, and there is a substantial risk of loss in short term and option trading. And also consult your advisor, your clearing firm, and any other advisor you might have before you entertain any investment at all in anything. With regards to a quick introduction on myself, I'm Jim Kenney. I provide the content for OptionProfessor.com, and I've been in the arena of investments for many decades. I have done seminars throughout the country, educating thousands upon thousands of people nationwide in hundreds and hundreds of option seminars. And what I am here today is to give you my views and my opinions on what I see on a few things. And also, if you have any questions on anything as we proceed, just simply use the email address of optionprofessor@gmail.com. And you can send a message over anytime you'd like. With regards to today, as always, I'm going to give you a quick overview on some things that are going on. Then I'm going to go into all the different markets, including the stock market, bond market, the dollar, the metals market, and the oil market, among other things. Okay, let's go over what the big news here today is, and that's Chevron taking over Anadarko. And basically, that has put about a 30 to 40% premium on Anadarko, and it has taken the shares of Chevron to the downside. Let's put that up real quick so you can see what's happening. Here's your Chevron stock. And that has turned south in a pretty decent way, down about 5%. You know, this stock, while it's done pretty good this year, I was told over the last 5 years or so, it's really up very very small amount. So this does pay a good dividend. That's why people probably hold on to it. 3.96 is what I'm showing here on the yield. But you can see on the price, it was up at 112, and now it's down to 105. They're putting up stock and cash to buy Anadarko. And let's talk. And that was a company that I had brought to your attention in previous broadcasts, because it is a company that in the industry sector is very well respected and been going up pretty good already. As you can see, it's not even at the 52-week high, though, even with the big jump of 32% today. Let's put the chart up here a little bit easier to see, and you can see what happened. Yeah. So basically, this was a company that was turning. And when we were talking about energy in prior shows, we did mention that Anadarko would be in one of the groups if you were interested in the energy shares moving higher that you take a look at. And obviously, it came out of a nice base here, and then the news hit, and then bam, you're up towards $65 a share almost today. That's a pretty big size jump, obviously, and that's the takeout story right now. Okay, so that's what's gone on in energy today. There's some consolidation in the industry, and that's basically what's been happening. Let's do another thing here. What happened today was earnings, and JP Morgan came out with their earnings, and some of the numbers seem to be very well received. It did jump up to almost 112. Now it's back down to 110 and change. So no big follow through after the jump, but it's still up 4% on the day, and that's nothing to sneeze at on a big company like that. Again, people are very concerned that the earnings are going to be very bad. You can see the breakout here to the upside, and there's a big gap there now. So it comes down and tries to fill in the gap a little bit, but it's still very firm, paying just under 3% dividend, and basically it's up about 4% today as we speak. So again, big move out of those guys. The other guys who came out, Wells Fargo, not so much. Wells Fargo, I think, is going the other direction here. Again, Wells Fargo has problems, and their CEO just changed over and things like that. So the enthusiasm for them, they went up on the opening, almost $49 a share. I'll show you that in a second here. But again, it came right back under sea level. This 48.50 area is a tough racket for Wells Fargo. I think you'd really have to clear 50 to get interested in it. 52 would be very interesting. Up until that point, you could be looking either at dead money or money that's fading on you, and that's not very good. Obviously, best of breed seems to be JP Morgan still, so that's the way the bank situation is going. Let's look at the banking ETF. and see if there's any across the board strength there. And there is. It's up 1.5% today, 27. Again, it went up to 27.33. It's still above 27, but it does look like it is trying to break out to the upside a little bit. So let's see what next week brings. But obviously, if it does to break out, this number here at 26.5 would be where I would say you might want to keep a tight stop on it and see if this thing can keep going. Obviously, 25 is a big number for longer term holders. You start taking out 25 and you probably got some problems in the banking financial sector. But right now, you can't fight the tape, and the tape definitely looks like it's turning to the upside. All right, let's see what else is going on with energy, because, we had that big takeover. Is that across the board activity, or let's see what's going on there? Yep, we're up a little bit, not much, 67.51 on the XLE. And so basically, again, if it can get above 70, it would be looking pretty sharp because, again, that's the former high right over here. And I think the moving averages are turning to the upside on this. So if we can stay above 64, 65, I think that's very constructive. And you start blowing out 70, then you might start getting into some more rarefied air. Looks like there's a little bit of a gap here at the 75 mark. I don't know if the market will go after that, but it may. Let's turn toward the major indexes now. I went over a couple of sectors, the energy and the financials, which are both very popular with people right now as far as exposure is concerned. And let's take a look at the broad-based index and see what the stock market looks like. I think the stock market's getting a little extended up here, but that's just me. Again, you can't fight the tape. The market has been rising. Let's take a look real quick here and see what's going on. We've got the S&P was at 29.10 on the high. It's at 29.03, so it is backing off a little bit off the high as we're getting closer to the close here in the last 45 minutes. Let's see here if I can. There you go. Okay, so as you can see, a lot of the moving averages that I look at, the longer term averages, are in the 2450 to 2600 area. So, you get up to 2900, you're getting very far away from longer term moving averages on the monthly graph. And ergo, that's an overbought condition. So on prior shows, I did discuss that when we went down here to 2350, we were looking for a potential of it going back towards the moving average of the 200-day and the 50-day, which is around the 2750 area, which is what it did. So it went back into this neighborhood here, right? And then a lot of the Elliott Wave guys that I've been listening to, they thought it would go up towards that 2940 and test the high, which I think is exactly what it's doing right now. So it's in the process of trying to get to that 2940 area. I think somewhere between 2940 and 3000, if these moving averages are in the 24, 25, 2600 area, that's a fairly overbought condition basis the moving averages. And the valuation of the stock market right now, I think, is up near 17, 18, and the norm is right around 15. So you've got a little bit of an overvaluation. And you've got a very, very big month of April, because April has been a very good month for stocks. But now you're going to be looking at May, June, July, and the earnings are going to be coming out. Now, the earnings, I guess, on JP Morgan was okay, but Wells Fargo, not so much. And the earnings looking forward, a lot of people do have their concerns about it with regards to how they are going to shape up. So some people are looking for this first quarter to not be so good and then pick up as the year goes on. The market's a discounting mechanism. So what we're seeing here is probably a 6-month discount on what we might see towards September. We'll have to see. But basically, the earnings are supposed to be getting some lift as we go throughout the year. Also, the comparisons obviously get easier because of the tax cut last year. The comparisons for this quarter are a rough racket. They get easier as you get forward, and as you get into the fourth quarter, they get much easier. So that's why people are very much predicting that we could see as much as an 8% jump in year-over-year earnings as we get to the fourth quarter. Of course, those are projections, not assurances by any means. Okay, so now you see the S&P still on a roll here. And of course, China came out with some information today that was very positive, Chinese data. But their exports, of course, we're trying to get the trade balance together, right? Well, their exports are going through the roof, but their imports are not moving at all. So some people are saying that on an internal basis, they've got their internal economy going, but it's not really helping the externals very much right now. So again, that's what makes people think it's a little bit of a mixed bag as far as the Chinese data. Yes, their exports look fabulous, but their imports didn't look that great. So a little bit of a mixed bag there. Okay, now let's get back to some of the indicators and some of the things I look at when I'm looking at the market. Now, again, I am suggesting the market's getting a little bit overbought up here. And if you believe that, this might be the time to do a little protecting of some of your equity in some of the positions that you might have some big gains on. A couple of ways to protect your equity would be married puts, where you use put options as insurance on your stock. And then, of course, if it doesn't go down, you lose the premium and all cost involved with it. And if it if it does go way down, you have some mechanism underneath that gives you the right to sell, but not the obligation. That's what a put option is all about. Now, what about collars? That's where you sell an out of the money call. Some people might consider just doing out of the money call selling here and grab some premium if you think the trees are close to the sky up here. Now, with regards to collars, you're going to take that premium if you do that type of strategy, and you're going to buy puts using the premium that comes out of the calls. You know, if you're concerned that you really don't understand, or you need a little bit more definition on the how it works as far as the put, married put, or the collar, I'm more than happy to try to answer some questions for you and clear up the use and the risk of the strategy. That would be simply by emailing me at OptionProfessor@gmail.com. And I'll be more than happy to converse with you. Also, if you have friends or associates who are in the market and don't understand how this stuff works, you can give them the link by going to OptionProfessor.com and just give them the link to the show, but also tell them about the OptionProfessor@gmail.com and take advantage of that. And I'll be able to try to help you if I can. All right, now here's the VIX. Okay, the VIX is getting very low, and the stock market's getting a little bit overbought basis the moving average. So the combination of that obviously makes the 2,900 to 3,000 area, in my view, a bit rarefied as far as the air is concerned. And so I'd be a little bit careful about initiating anything new up here with now you can't fight the tape either, but again, 2940 we know has been the former high. We understand that some of the long-term averages on the monthly graph going back 1 year moving average, 2 year moving average, 3 year moving average, are getting a little extended. And the VIX is in an area where obviously it can sometimes come out of this area. As you can see, when you're down in this 10 to 12 area, sometimes it pops out. Well, if it pops out, that means you get a correction. So again, be a little bit careful up here. Again, as I told you with the VIX, if you're above 25 on the VIX, you got to be worried about a big type drop. If you are between 17, 15, and 25 on the VIX, then you're probably in a stable to higher environment. And again, when you get between 10 and 12 on the VIX, you may very well be near a high point. So again, we're in that neighborhood. That's an indicator that's telling me we may be getting extended here sooner rather than later. All right, now let's look at some of the other indicators that had been turning very positive for me, and that is the transportation average. That was in the doldrums. And again, it's on the horse right now. It's almost up to 11,000. But if you notice, 11,000 is also where it had stopped out before. So again, you're up near 11,000. And the 50 and the 200-day moving averages are still inverted to the downside. So I just would say that the market looks very good. Anybody can tell you that. But I also would say that having a little bit of cautiousness up here may not be off the charts because, again, we are getting a bit extended. We've had a very nice big run, right? I mean, look at the run from December here. 8,500 to 11,000, right? Now, again, the Fed has said they've paused. They haven't said they've gone on vacation permanently. And if the numbers start coming out very strong in the economy, I don't think easing is going to be the next move. And again, on the monthly graph on the Treasury note, which I will try to get for you, the long-term moving average, the 3-year moving average on the monthly graph is still in a downward trajectory on the price of treasuries, but it had a big rally and touched the moving average, but now it has rolled back down. So the uniform idea, which is obviously 100% different than it was just in December. I mean, December, it was all hikes, hikes, hikes. Now 90 days, 120 days out, they're never going to hike again. Well, that's pretty radical moves, and I don't think the Fed makes radical moves. Plus, I mean, for gosh sakes, you're on the all-time high on stocks, all-time high on unemployment. Unless you're trying to give, artificial jumps to asset prices, lowering the interest rate and going into quantitative easing sounds like lunacy. But anything can happen in this world, but that's what's happening right now. All right, here you go. As far as so the transports look pretty good, but again, they are going to possibly run into some resistance at 11,000, possibly. Their all-time high up here also is still intact. So despite all the big rally and the markets are going nuts, they're no higher than they were last year. That's last year's high. Okay. All right. Now let's talk about the Russell, which has been really lagging. That's 2,000 stocks. Let's see what it's doing today. It's up 3. Okay, so Russell's coming up near that resistance at 1600. You can see that it went up to 1590 here. So there's some resistance up here. We'll have to see if it can get taken out, but it's still well underneath the highs of last year. And why is that? Because the participation in the secondary or the growth stocks is not keeping up right now. Also, some believe that in the future, as money flow goes into the market, it will go to the ones that have higher growth and higher earnings. So when you see these earnings come out, if you see revenue jumps, if you see earnings jumps, those might be the horses that are going to be ridden, as opposed to many in the Russell 2000 who may not see those numbers. So the bottom line is it could be money chasing fewer stocks in the months ahead. Also, just because you're in the indexes or in your ETFs, and you're being bought as a company, but your numbers aren't any good, those companies may fade as well. Again, the money may seek out the companies that announce good revenue growth and good earnings growth, and they may fade or at least stand aside on some of these other ones. And again, the Russell is certainly lagging the other major indexes in a big way. So keep an eye on the Russell, keep an eye on the transports. If they roll over to the downside, that could give you a tip that the S&P might not be far from its short-term apex as well. Okay, what else can we cover here today? We went over the oil sector. We went over the financials. And a couple of places where people are now getting bullish because, well, let's look at the Treasury note. Here's your 10-year note, interest rates, right? Okay, well, we're back up on the bicycle here. We're at 256 on the 10-year. We were at 235. You can see that, 235 not very long ago. Take a look at this graph. Okay, because again, the markets don't always have a situation where they will, let's see what I can do here. All right. They don't always, stay on trend here. Now, obviously, we were uptrending in interest rates. We go up to 3.25% here around November of last year. And then the stock market goes in a dive. And so in December, these yields start dropping. And then Powell in January starts announcing that they're going to be on hold. And by March, people are really giving up any idea that rates may rise. Well, when everybody gives up on something, obviously that might not be a bad time for you to give up on it as well. So right now, yields seem to be rising a little bit. There should be some resistance here at 2.6 and 2.8. So if you really want to get back on the yields might be rising wagon, you'd like to see it above 260 and 280. Right now, again, the downward trajectory on the yield is still in force, but that's only on a weekly, yearly graph, right? If I have other graphs that I could show you, but I'm not going to be able to show you today. So if you have an interest, email me, OptionProfessor@gmail.com, and I'll get you some more information on what the longer term graphs look like, the monthlies and the monthly moving averages, because they're not going to bend as much as this. A monthly moving average and a monthly chart, it doesn't bend as much as this. Okay, so or a yearly moving average, it doesn't bend as much as this. It gives you a more smoothed out picture. But again, that's what's going on, a little bit of higher in yields. So let's see what that's doing to fixed income here, because many of you people might be in fixed income. High yield bonds, how are they doing? Okay, well, they're flat today, and they're at a pretty high price at 87. So be careful on these as well, because, again, when liquidity dries up, you can see what happens to the price of high yield. Again, I've been told that there is about 10 trillion in negative yielding bonds and 10 trillion in either leverage loans and high yield bonds and also these things called triple Bs. Now, triple Bs is the first level of investment grade. So if things that are in triple B ever get downgraded one level, they'd now be unable to be put into investment grade products. And that could cause a very significant amount of selling. I think that's where the Achilles heel is on this thing looking forward. Now, the other problem is leverage. Right now, 50% of triple Bs, I was told, I can't guarantee the information, but I had heard on a financial forecast program that 50% of triple Bs has leverage of 3 to 1, whereas years ago it used to be 25%. So the leverage is moving up. You can see people are buying it in droves because they're desperate for yield. And the difference between high yield and treasuries is collapsing very tight, which means you're not really getting paid for the risk that you're loaning companies, some of them leveraged money. And of course, when you loan people money and it becomes a problem, as you saw with the real estate crisis, and then you try to get rid of securities that nobody wants to buy, it can become a problem. And anybody who's bought and sold individual bonds know that the liquidity on some of these things is not the greatest in the best of times. Never mind if there's a real reason for there to be a significant amount of selling. Also, when you see the stock market rising, you might ask yourself how long will people stay in negative yielding bonds when they could be buying into some stocks that might be rising or high yield or something else. So there's a lot of things to worry about in fixed income that people are not worried about, and complacency can be a problem. And that's why that 12 on the VIX is in an area where complacency is very high. And the prices are near their all-time high. So that could be something to be keeping an eye on. And again, the distance between the market and where the moving averages are on the monthly graphs, and look using the yearly moving averages, 1 year, 2 year, 3 year, is, in my view, extended. We'll have to see how things pan out. Okay, U.S. dollar has been very firm. Okay, very firm, and it has been firm between the numbers of 95 and 98, and it's been firm here for a while. This is the U.S. dollar. Okay. Now, again, a lot of people in the administration seem to think that they like to see that dollar drop. The administration wants the S&P and the Dow Jones to keep going through the roof. There's clearly that's because that's their report card, right? But the problem is if you do it through artificial measures and then the fever wears off, then obviously the decline can be just as damaging and really take out a lot of things. So, growth on the GDP, when it goes to 1%. That's why they're so afraid of a contraction. If it goes to 1%, that is when you start seeing problems in different areas. So that's why keep an eye on the GDP. If you ever see it shrink down towards 1%, then you should be expecting problems in the economy. All right. Right now you're at 97. So, it's been going back and forth for how many months? A long time. You're going way back here now, right? So it's been in that range. But you can see if we can break under 95 and 94, and I'll even give you a longer term graph so you get my idea. Let's go look at a little longer term graph so you see, because this is going to be the big story. If this dollar drops, it's going to change things dramatically. All right, you're at the 5-year graph now. So let's take a look at the 5-year. Okay, you see what I'm saying? If you break under 95 here, 94, going down to 90 is certainly not out of the question. And if you break 90, there's nothing underneath it. Okay. So if they really want this dollar to drop, and if it starts breaking, that should be very, very much helping the multinational companies who have to do overseas, but it probably will have something good going on in the price of gold. So let's take a look at gold right now as far as the GDX is concerned. And it was very good last summer. When it bottomed at about 17 here, and then it went on a nice run up here. Clearly, it needs to get above 24 to be very good, but the trajectory is still to the upside. Now, if the dollar remains strong, gold's going to have a hard time of it because, again, gold likes to see inflation and a weaker dollar, and it's not getting much inflation out of the official numbers. Although we all live in the real world, there seems to be inflation every time we buy something, right? But at any rate, it doesn't have a weak dollar here. Another stock in this area that I've been watching is Freeport McMoran. And today it had a pretty good day. Let's see how it went home. Yeah, it's gone up about 3% today. It was up almost to $14 a share today. So there was some action on this earlier in the day, and then it faded out a little bit. But this is another company that used to be way up at the 40-60 area that went down to 5 area, and then it went back up to 20. Now it went back down to 10. And if this 10 is going to hold and they can start taking out 15 and 20, this could be something to keep an eye on. And if the dollar does crack, my guess would be this might benefit. So keep an eye on that because 13 and 10 and all that kind of stuff is pretty cheap. And this is a fairly good sized company, almost $20 billion in market cap. So it's got a pretty good sized company. All right, let's take a look overseas real quick, and then that'll be about it for today. BABA, which something I talked to you guys about in this broadcast in the 130 area, 140 area. It's at 188 now. Again, the numbers came out very good, so that was very positive today, up 2 points. But again, people have been buying into this thing for a while. As you can see, this is 2019, bottomed out at 130. You can see here, and it's been climbing steadily. If it takes out the 200 area and China's economy continues to roar, then this thing may keep going. What's the risk up here is that the import numbers that were weak are an indicative situation that their economy really isn't that strong and that their export numbers picked up, but it couldn't pick up the import numbers. And ergo, we could be getting ahead of our skis here. So looking up here in the 200 area, there could be some resistance, unless, of course, they keep knocking the ball out of the park on the numbers they come up with. Another company that they look at over there is Baidu. And let's take a look at what that baby's doing right now. And that's up not as much. And it's had a pretty good rally of about 20 bucks. It's not nearly as extended as BABA, but it might have some value down here. Why is that? Because there you go. You've got some bottoms in there right under 160, and you're trading right up there at about 172. Today or recently, it's gone up towards 180 and change and pulled back. P/E ratio doesn't look too rich, and so that would be another way to go. Another one that I've been looking at is Brazil. You know, they got that new guy down there who's supposed to be the Trump of South America. Well, you know, let's take a look at it. It again, these are 5-year graphs to give you some perspective. I would say that if you can start closing above 45 on this, that it might be worthwhile because you've got higher lows and higher highs. But we need to take out that 45 to get back on the bicycle. And so it does pay 285 on a dividend, so you get paid for watching the movie. But, you know, he's trying to shake up things down there. And if he's successful, maybe he can get Brazil back on the bicycle. It is a very, very large country down there. And he's supposed to be very, very pro-business. You know, finally, we could finally look at just a couple of sectors real quick before we sign off. These are going to be Vanguard ETFs, and we'll go around the horn to some of the different sectors here. The industrials, okay? They look like they're trying to get back on the bicycle, or they're double topping here. Hard to say. Let's look at a company that's in the news here, and let's say we're looking at Baidu. Okay, I mean not Baidu. I'm sorry, Boeing. Baidu. Boeing, and you can see Boeing again had bad news, and it went way down towards that 350, 360 area. When we were up at 440, I was telling everybody that the moving averages were in the 350 area. So I thought that it was overbought up there and it might pull back. Clearly, I didn't know there was going to be crashes or anything, but it's amazing how news fits the chart sometimes. So you came down and look at that volume. That looks like Tom, Dick, and Harry all sold out. So, you know, being constructive on Boeing because A, they've got a very, very good order stream coming, and B, they're a very well-run company. Might not had been the worst idea. You know, your line in the sand is right there. You certainly don't want it under 350, and it does pay a pretty healthy dividend of 2.17. And so basically keep an eye on that. Getting back above 400 is a key, though. You really would, if you're bullish, you want to get it back above 400. And then let's see, I got 1 minute here. I'm going to go over a couple of techs real quick. What's Apple look like? Apple has had a rebound back up, and it looks like it might be stalling out here. Whatever this week's high was, just above 200. Let's see if it can take it out next week. If it can't, then it could be at the time for selling calls on that as a hedge. Might not be the worst thing. At least price them out and take a look. And then Amazon is trying to say that maybe some of their earnings may not be up to snuff because they're going to be spending money on projects. Well, that news could be a little bit sobering for a company that's at 91 PE ratio. So you have to be a little careful on that. So this week's highs in both Apple and Amazon might be worthwhile to keep an eye on. If they last another week or two, then it might be an indication that we got tired up here at this week's highs. Keep an eye on it in the next week or so, and you should be able to have a better idea. Okay, well, we did cover quite a bit today, as we always do. And next week, we've got a lot of earnings coming out. Again, many companies coming out next week. And so I will be covering those with you next week. And I will be letting you know my opinions and my views on where things are going. If you have any questions, again, shoot me an email, optionprofessor@gmail.com. Until next Friday, I want to wish you all the best of trading. And of course, have a great weekend. And again, next week, enjoy your Easter as well. We'll be back with you not next Friday, but next Thursday. And again, till then, have a great day.